All right, I have 3 places I want to go with you. First place, it looks to me like the Fed did a swap. They swapped a tempered taper for a bigger promise to keep rates low longer. Your thoughts?
Well, what you've already seen in the marketplace is you've seen a significant flattening of the yield curve. We think that's going to continue, as well as once people start putting on their strategies for 2014, we're looking for significantly higher interest rates also in the back end. We think 5 years will probably get more towards 2%, 10 years around 3.25%, and long bonds well over 4%. So we're looking for a significant backup. With the Fed tapering, the safety net of treasuries is no longer going to be there.
All right, now you already hit my second question. I wanted to talk about how we squeeze the water balloon from that little taper that still keeps stocks happy for a while to what the flattening curve says about the long-term low-rate strategy. You hit on it briefly, but I want to expand on it. Are we seeing really a logistics unwinding of long positions on the curve for the steepening, or is it more what can we maybe read into it?
I think what people are looking at is when you have a GDP growth of 4.1, as well as a lot of other things going on, maybe ex-inflation, which we still don't believe is as low as it is, but as you have the strengthening of the economy, I think it's going to be much tougher for the Fed to keep short rates down as much as they think they will. Because if they're going to eliminate the taper, they can keep short rates as low as they want. But once the 5-year starts going against them, we think you're going to go to significantly higher rates, and this Fed compression of rates will start to be reversed.
All right, let's say that last interpretation spot on. In the last 20 seconds, tell me how that commingles with the Fed's balance sheet, leveraged to the tune of, according to your research, 71 to 1.
The Fed is vastly over-levered, and a lot of people will say, well, that doesn't matter because it's the Fed, and they can always go to Congress. Well, Congress hasn't been the easiest people to get along with recently. And when you start showing $100 billion losses as you go to higher interest rates and you have extension of mortgages from convexity risk, the Fed is not hedging anything. I think that's going to be significant, and you really got a Lehman-type situation, of course, with the government backdrop.
Listen, Andy, I'm out of time. I wish we could talk about it because you brought up the right example, Lehman. My biggest fear would be a spike in terms of the flattening, most notably under 5 years. We'll have to wait and see.